Hello, good morning, and welcome to Mortgage News Live, your fortnightly deep dive into all things mortgages, interest rates, and home buying. Now, we've got a packed show, an expert panel for you today. Whether you're watching us live or you're watching us back on YouTube or listening back on Spotify, you're very welcome. We've got no shortage of things to talk about today. We're going to take a look at the interest rate mood music, what we might expect when the Bank of England's Monetary Policy Committee next meets in early November, and then, of course, the big one. We are now just 2 weeks away from Rachel Reeves's first budget, the first budget ever by a female chancellor in the UK, and the first Labour budget in over 15 years. The last Labour budget was in March 2009, would you believe? And we're starting to see a few leaks, a few nods and winks, a few rumours about what might be in this budget. So we'll have a look at that, what that might mean for mortgages, your clients, and of course we'll dissect and discuss with our expert panel. Remember, of course, if you're watching us live, you can take part two. You can see a comments panel, hopefully on the right-hand side of your screen. If you want to ask a question or make a comment on what we're talking about, just pop it in the chat there. We in the panel will all see that. But let's introduce you now to our expert panel who are joining us today. We've got Ros Kaywood, who's Managing Director of Property Finance at Stream Bank. Good morning, Ros.
Hello.
What's Stream Bank, for those of us who don't know?
So Stream Bank is a relatively new challenger bank. We got our full banking license back in February 2023. So we're in our sort of second full year of trading. And as well as having our sort of saving side of the business where we raise our deposits, we have the lending side of the business where I focus on, and that's mainly short-term bridging finance.
Well, Ros, thank you very much. You're very welcome. With us as well is Peter Stimpson. Peter is Head of Product at MPowered Mortgages. Now, Peter, whenever our paths have crossed in the past, I've kind of got you down as being the guru of all things swaps and interest rates and designing mortgage products. Is that a fair assessment of what you do?
Sort of, yes. I mean, it's anything to do with products, product launches, interest rates, anything around product launches, basically. So that type of thing.
Well, we will be delving into your expertise today. And the final member of our panel is Stephanie Daly, who is Director of Partnerships at Alexander Hall. Stephanie, good morning.
Morning.
Morning. Tell me, Alexander Hall, you're a mortgage broker, right?
We are. We have just shy of 50 mortgage advisors at the moment. We are primarily London based, and we are linked with the Foxtons Group, and we transact with all types of mortgages, so residential, buy-to-let, as well as some of the specialist bridging development commercial as well.
Great. Well, we have got a real brains trust for you today, both lenders and brokers on the panel today. So I guess let's just start off to get the ball rolling with a little look at what's going on with the products. It's been a busy couple of weeks for products. I guess first question to you, Steph. You mentioned that you've seen a couple of interesting changes in products being launched with lower early repayment charges.
Yes, so just this week we have seen Halifax, for example, come out with their no early repayment charge tracker product, which puts them at the same level as some of the other high street lenders that are also offering the same no early repayment charge trackers, which I think is a really, really good option, and it's good to have more lenders available in the no early repayment charge space. There are so other lenders which have come out to be slightly different. So April, new lender who actually we've recently onboarded with, and they of course are all about the longer term fixed rate, so 5, 10, 15-year fix, but no early repayment charges when you sell the property. So I think for those clients who are maybe considering moving in the next 12 to 18 months, it's a really good option, especially where there is now quite a bit of unsurety about what actually will happen with the Bank of England base rates. Because of course with trackers, you are at the mercy if the Bank of England base rate doesn't change as quickly as some might expect. I don't think it'll go up again, but I think something terrible would have to happen for it to Bank of England base rate to go up again. But Peter, you'll know more about that. But it may not drop as quickly as certain forecasts are currently saying. So to have the option to be able to fix and still have no early repayment charge is something that is incredibly rare in the market space. Other flexibilities with some other lenders as well. So 5-year fixed rates with 2-year early repayment charges, like Virgin Money, for example. All those initiatives around products and early repayment charges is something that we have been lacking, I think, in the market recently. So it's definitely good to have more options in that space.
Ros, you mentioned that a few lenders have been launching Halloween-style mortgages. There's something in the air, isn't there?
Oh, definitely. Over the last month or so, we've seen some of the lenders sort of reducing their rates downwards a little bit. But now I think we're seeing more sort of criteria-led changes. So yes, there was a spooky deal that's just come out today, where it's looking at maybe on development where traditionally you'd have sort of 70-75% day one loan, and we've got someone coming out today with an 80% day one and 100% costs of works funded. And so we're sort of seeing them pushing on the sort of criteria changes. So perhaps where they're just hedging their bets about what the rates are going to do, looking more at criteria rather than at this moment moving on their rates.
What about the number of products coming out? Obviously, we saw a flurry of competition, new products coming out in August and September after that first base rate cut. I get the sense that there are now fewer product launches. Is that fair, would you say, Peter?
I think there's as many products out there as there have been. I think the rate of change has slowed down, but the rate of change has slowed down because of the fact that interest rate or the swap rates have stopped falling. They've actually gone into reverse. So we've seen the last 10 days swaps going up by around 18 to 20 basis points because of various things happening. Basically, the market has, from a lending perspective, it's absolutely cutthroat. So you typically look for something like 20 to 30 basis points of margin over the swap. We've now got lenders lending below the swap rate. So obviously, Steph mentioned Halifax. I'll also mention Halifax, give them a bit more PR. They've got a 5-year fix out at the moment at 3.77. The 5-year Sonia swap this morning was 3.83. I can't recall the last time I've seen a lender offering a 5-year fixed rate below swap. I'm not quite sure how they're funding that. It's absolutely, mad. In terms of the margins they're lending at. So the rate of change has slowed down, but the level of margin or the profitability on these products is just gone through the floor. So at the moment it's not exactly a great place for lenders in terms of profitability. I know probably people are going to get the world's smallest violins out, but that's kind of where it's at from a lender's perspective.
Yeah, no, that's very interesting. But from a broker point of view, there is certainly opportunity there. If you're getting that kind of level of competition, there is clearly scope for finding best deals for your clients there. Peter, you mentioned swap rates nudging up. Now, maybe you can help us with this one, because I must admit, when I heard the governor of the Bank of England say a couple of weeks ago that he was ready for them to start aggressively cutting base rate, and then I saw a steady stream of relatively positive economic data. So we had the GDP data that showed that we're back to growth last week. The wage growth data this morning shows that the rate of wage inflation has fallen again. It's now at its lowest level for 2 years. We've got consumer inflation data coming out tomorrow. Could be that goes down even lower towards the 2% target that the Bank of England Monetary Policy Committee likes to stick to. So if all of that is going to plan and wage inflation is coming down, consumer inflation is stable, Bank of England governor is talking about aggressive rate cutting, surely we should see swaps coming down and it's kind of fill your boots, base rate cuts to go, but not so, Peter, you say?
It could be, but there's quite a lot of contradictory data out there. So there's some. Positive data is not necessarily positive in terms of interest rate cuts. So if the economy looks like it's growing, obviously that a growing economy could be perceived as inflationary. So, a growing economy puts pressure on wages, puts pressure on, employment numbers, etc. So, I mean, what's driven the latest increases is kind of a combination of things. We've obviously got Rachel Reeves' budget coming up fairly shortly. Lots of rumours going around about what she's going to do. One of them is obviously potentially changing the government borrowing requirements. If the government needs to borrow more, it will put pressure on government gilts, or what the government needs to borrow. Gilt yields have been rising. So, for example, the 10-year gilt yield has gone up nearly 50 basis points in the last 3 or 4 weeks. Obviously, swaps are backed out by gilts. So, obviously, swap prices have been rising. US job numbers have come in much more positive than expected over the last about a week or so ago. So, the US rumours that the US was potentially entering recession doesn't look like it is. So again, there's less pressure on the US to cut rates aggressively. And obviously, what's going on in the Middle East is putting pressure on the oil price. So again, that could be perceived as inflationary. So whilst the governor of the Bank of England may sort of have this kind of optimistic long-term view that rates are going to be cut, a lot of the data out there seems to be pushing swap rates up. That's kind of where we are at the moment.
So with that in mind, where do you think we might see the Bank of England go? They've got 2 Monetary Policy Committee meetings left this year, one on November the 7th, another one in December. It seems like just a few weeks ago, we were talking about them definitely cutting both in November and again in December. It sounds like the odds of that have lengthened quite a bit, Peter.
I think going to be quite dependent on where CPI comes out on or tomorrow now. So I think November, sitting here now, it's a guess. I think probably 50-50 or maybe even slightly less than 50-50 for November at the moment. And probably slightly more than 50-50 for December is probably my best guess. And it really is a guess at this stage. But I'd like everyone to kind of remember that obviously bank base is 5% at the moment. Sonia's swap as of this morning was around 405. Anticipated rate cuts have already been priced into the swap curve. So even if we get a rate cut in November or even December, it's unlikely that's going to be passed on in fixed rate costs or substantially passed on. It's already been priced in. So, that needs to be borne in mind by brokers out there.
Ros, you mentioned that because of this uncertainty, there's a lot of kind of wait and see going on amongst lenders. Do you think that they are just waiting for the base rate decision, or there are other drivers that are more important for them?
I think more than the sort of lenders waiting, I think it's actually the clients. I think some people are thinking, shall I invest in a property? Is this the right time to move? What am I going to do? They might be coming off a fixed rate, and do they go on to a standard variable, or do they fix in again now? I think a lot, especially at the beginning of the year, we were seeing some people hedging their bets that they were almost guaranteeing that there was going to be lower fixed rates by the end of the year, and so they were holding out. And obviously now we're in the situation where Peter's just described, where maybe it hasn't sort of borne out. So I think people are just waiting to see. I've spoken to a lot of estate agents recently who, all their clients are sort of waiting to see what this budget outcome is going to be and how it's going to be perceived before actually sort of putting their hand in the ring to do transactions. So I think it has been a sort of sticky and sluggish year in that regard. Yeah.
Does that match your experience, Steph, on the kind of customer front line? I'm guessing there are customers who are ready to move, keen to go, but thinking, if I can just wait another few months, my interest rate will be that much lower. So are there people holding off because of that?
Yes, definitely, and especially in the first time buyer space, or if you don't need to move immediately, but if you'd like to move, essentially, then it's let's wait and see what does happen in the future. But I certainly think that's a risky tactic, because there's a lot of people that are doing it, and there's already not a huge amount of stock and supply available in the property market. So if these clients were to wait, okay, yes, mortgage interest rates have come down, but if you're having to pay an extra 5-10 grand to get the property that you want, you've lost all that saving on the rate anyway. So whenever I'm speaking to clients or advisors speaking to clients, it's sort of that balanced view, because yes, I mean, if you find a property that's suitable for your needs, suitable for your family, if you need to move, then obviously do it. And also in between now and when people actually exchange or complete on the property, that could be 3 or 4 months. So if interest rates do change during that time, we can always look to swap the rates to get you that better products anyway. But I think the people have been waiting and seeing, it seems, for since COVID times, because there was all that press that property prices are going to crash and all the prices are going to drop of anywhere between 15 and 20%, and we just didn't see that. So if people are still waiting for this bubble to burst, in my opinion, that's just not going to happen. We did see a slight decrease in house prices. That's now going the other way. And I think once interest rates do continue to drop further, then the house price growth will continue to go up as well.
Well, a couple of points on that, Steph. You're absolutely right about house prices. We've got both the Nationwide and the Halifax HPI showing that average prices are growing across the UK now. So the only way is up in terms of house prices, and in terms of getting a reasonable value for the property you want to buy now is as good a time as any. And then this kind of pain benefit question about waiting. I mean, you can sort of see the kind of rationale for holding out another few months in the hopes that there will be cheaper rates available then. But let's say a client comes off their fixed rate and goes on to their SVR now, with base rate at 5%, SVRs are still punitively high. What's a typical SVR that you're seeing?
Starting with a high 7 or an 8, a lot of them there.
Yeah. You don't want to spend many months on that, do you? Yeah. So the cost of waiting is very, very high. Even if you get a good price on the house now, it makes no sense to wait for a cheaper interest rate, because saving will be gone. Yeah, very interesting. Okay, so it's a busy market by the sounds of it, but there's still this sense of wait and see. And as Peter has said, it's not a straight slam dunk for a base rate cut in November. Peter, I know I'm not a betting man, but if you had to give us odds for a cut in November versus December, what would you say?
I wouldn't put money on November. I mean, you've got to bear in mind it was 8-1 voted against a cut last time round. I'm not seeing the data which is saying a cut in November at the moment. I mean, who knows what the CPI comes out with tomorrow, but yeah, I mean, I'm not seeing anything dramatic at the moment. But I mean, bear in mind, we've got Rachel Reeves, we've got obviously CPI tomorrow, we've got Rachel Reeves' budget ahead of that. So lots could change, but you know, this far in advance, which is, like I say, 3 weeks ahead, I'm not seeing anything which is telling me that they're going to cut.
Okay, well, watch and wait.
Well, and also looking at the swap rates as well, the markets aren't seeing anything which is telling me they're anticipating a cut either. So,
yeah, I was going to say, yeah, we've seen a lot of fixed rates already sort of heading north. There's been quite a lot of moves last week and this week. So, yeah, interesting times.
Yeah. I just wanted to add as well, just in terms of the wait and see approach, we've had the same, obviously sort of speaking about home movers, but remortgage clients seem to be taking the same view as to wait and see, and sort of really leaving it up until the last minute where they need to submit their remortgage application to see if rates are reducing, which of course over the last 2 months it's been lovely conversations that since last time rates have dropped down, and that's now a change in the conversation. So it's now more of an education piece, like swaps have gone up. Okay, how does that actually impact the lenders and the rates? Why does swaps moving actually mean that your mortgage rates are going up? And we really do need to be starting to get remortgages locked in now, because it's likely that if I do speak to you again in another week or two, that I'm no longer saying it's a lower rate. I'm now saying you've missed the sub 4 rate, and we're going at something higher than that.
Interesting comment just in chat from Natalie Barlow on this kind of pain reward question about SVR. She sat on an SVR for a month with Halifax, and waiting a month got her a 3.96 fixed rate for 5 years. So it paid off there, but it didn't come cheap. She says that waiting another month on the SVR would not have been viable. So it's painful and you can't sustain it, but there is a case there for just holding on to those better rates. So I guess we really are in kind of crunch time here in terms of what the Bank of England does in November. And then, of course, what happens in the budget. That's the big elephant in the room, really, because it could move markets. So it'd be useful, I think, to have a little look at what's coming up there. So as I said in the introduction, we're now just 2 weeks away from Rachel Reeves's first budget as Chancellor, Britain's first ever budget by a female Chancellor. And we are starting to see a few rumours and a few leaks emerge about what might be in the budget. Still very hard to pin them down. It's a bit like nailing custard to the wall. The clearest indication we've had thus far came last night, actually, on national insurance contribution for employers. Now, if you remember, back in the election campaign, the Labour Party gave themselves quite a bit of strategic ambiguity. They gave this commitment to not increase taxes on working people. A latitude there in terms of how you define a working person, but there was no mention, of course, about employer taxes. And so it does seem like there's going to be an increase in the employer national insurance contribution, not the employee side. And of course, following that announcement last night, we've seen some squeals from people like the Federation of Small Businesses, concerned that this is going to add to the cost of employing staff. A bit like the Employment Rights Bill last week, that again adds to the cost of hiring people. So not a particularly pro-business measure there. But let's just turn the focus to what it might mean for mortgage lending, for house buyers, and particularly buy-to-let owners, because buy-to-let owners have had a pretty miserable few years, and there could be some more bad news for them in this budget. Changes perhaps to capital gains tax. Now, we don't yet know what these changes might look like, but it could be that capital gains tax, instead of being on a flat rate, it goes to your marginal income tax rate. So if you're a higher rate taxpayer, that would mean paying 45% capital gains tax, which is going to really hurt wealthy owners of second homes or buy-to-let properties. Steph, we were talking about this before we started the chat today. I mean, this is going to be really bad news, isn't it, for buy-to-let second home buyers?
Yes, I mean, I'm quite passionate about the buy-to-let sector, and it just seems that over the past few years, so since 2016, it seems to have been a war on landlords increase. So 2016, we saw the 3% increase in stamp duty for landlords. And then we saw the eroding of the amount of mortgage interest that landlords could claim against their tax return. We have seen quite sharp increases in mortgage interest rates that these landlords are paying over the past couple of years. And so, surprise, surprise, landlords are charging higher rents for their property because they simply need to. I have some friends who have properties, only sort of probably more social landlords, so 1 or 2 properties, and it seems like there's absolutely zero margin in being a small landlord at the moment. So, but the market needs them. So the market needs the people who can let out their 1 to 2 properties, because we speak a lot about the buy-to-let market becoming sort of more professional, doing it through a limited company structure, and that they are wanting to stamp out on the social landlords. But the sheer volume of what properties that these social landlords provide, the market needs, and there's such a focus on trying to get first-time buyers onto the property ladder, which is correct. If you can get onto the property ladder and that's what you want to do, then absolutely fantastic, and there's lots of incentives available for first-time buyers getting on the property ladder. Could always be more, but we'll come on to that in a second. But the fact that they're making it so difficult to be a landlord, and so if people are not going to want to be, then of course rental prices are going to continue to increase, which is then going to impact your first-time buyers because they can't save up as much deposit as they may have been able to in the past. And it just, I believe that it would be very bad optics for a Labour government to help landlords. So I understand that, but really by helping the landlords, you are helping the first time buyers as well. So it's not like all of a sudden, if you were to change the rule in terms of like your income tax, or I don't think we'll ever see a reverse on that stamp duty extra 3%. But it just means that we'll still have more property available. So there's been some research which has been published recently, although I think the research was done a while ago by Capital Economics, just as we were talking about the Labour was talking about the capital gains tax increase. So it's saying that the number of landlord-owned properties will shrink by 910,000 in the next 10 years. So the actual plan to increase capital gains tax could backfire, because although, yes, there'll be an increase in revenue from the capital gains tax, it would be negated by sort of a £26 billion slump in income tax revenue. So year to year, it would be over a 10-year period, it's calculated as a net loss of 3.6 billion for the Treasury. So it's looking at, although, yes, it looks like an immediate win, capital gains tax, we can make X amount of money, but really it's looking at that longer term view. How does that actually impact the landlords who, first time buyers, renters, people who are separating, they need properties to rent.
Yes, so a real risk of unintended consequences there. Interesting you mentioned the first time buyer question there, because as you say, squeezing landlords isn't necessarily easy money. It's going to have all those knock-on effects for people who need to rent whilst they're trying to save for a deposit. Ripples perhaps also for house building. And I must admit, that's an interesting one, because you probably remember during the election campaign, that great line that Keir Starmer said, we're going to be builders, not blockers. They were committed to building more homes. We're the party of YIMBYs, not NIMBYs. It was a good line. It probably won them some votes. But things have gone a bit quiet since they got in. There was supposed to be a target 300,000 new homes. That's coming back. Funny to say, it was never, ever reached by the last government. 3,000 new homes in a year. New government says it wants to achieve that. The issue, though, I think there is on the supply of new homes side, is that developers don't want to build cheap, affordable homes because the margins are not there. They want to build expensive homes that they can sell to families and make a lot more margin. And, it's one thing to talk about first-time buyers and the loans that they can get, but if the affordable homes aren't there for them to buy, well, how does that work? I mean, where do you think this stands on the supply of new homes, Peter?
Oh, that's a very long and complicated answer, this one. I think it comes down to, first of all, giving local authorities more power and making local authorities invested in the whole build process. So it comes back also to the buy-to-let. So I think part of the complication around buy-to-let is what buy-to-let has become rather than perhaps what it was intended to become. So buy-to-let, in my view, over the last kind of 10, 15 years has almost been used as social housing provision rather than letting local authorities almost in certain circumstances be providers of social housing. So I agree there should be a vibrant buy-to-let market for, young people and people who want to rent as a means of, working in cities at a certain stage of life. Unfortunately, what buy-to-let has become in many circumstances is a means of providing social housing for people when it shouldn't really be used for that. So, people having to use, housing benefit for, buy-to-let, et cetera, when, if you go back sort of 20 years, 15 years before, it was the remit of the housing associations and local authorities to provide housing to these people. So it's kind of become, a default mechanism rather than, something that it shouldn't be used for. So in terms of, the question about how do we build more, I think it's giving more power to the local authorities, granting planning permission for more high density developments with local authorities, stopping the objections or, against local people. It's also developing more at high density as well. So we still have, believe it or not, very low density developments in the UK, particularly in urban areas. And we still actually, believe it or not, still manage to build very small units. So we still manage to build very low density, very small units. Don't know how quite we managed to do that. So it's about giving more authority to the local areas, local authority areas. So it's a combination of a number of things.
Ros, this might be one for you, because I think you provide development finance as well at Streambank, don't you?
Yes, and with buy-to-let landlords, they have had it tough. There's the EPC new rules coming in, which will mean that they will have to improve the EPC rating on properties. And according to Rightmove, there's 2.9 million rental properties that still need to be upgraded, which is an average of £8,000 per property for works to be done. And so, there's a lot of landlords who are looking to maybe offload their portfolios because of the cost of doing it. And certainly the cost of doing that on a lower value property is obviously the proportion is greater than a higher value. So that's a concern for many landlords. We're seeing a lot of people who are purchasing properties to improve and rent out rather than just going down the sort of single dwelling route. Many of them are looking to HMOs because they'll be able to get more rental yield on a HMO, a house of multiple occupation, as opposed to a single dwelling. And some of them are turning to holiday lets and holiday rentals, like your typical Airbnb, to sort of try and get the revenue back. So there's different ways that landlords are trying to be able to achieve the rental yield, but also just in the development of the properties. We've seen since COVID that the cost of building materials has gone up, the timescales have been pushed out, and it's a lot harder now to actually get a good return on the money that you're paying to improve the property. So we've seen a lot of people where they're thinking it's a good investment, I can buy a property, improve it, and then I'll rent it out, and the figures just aren't necessarily working. So I think it's really important for anybody that's looking to get into that, or is to make sure, one, that they have a really good advisor that can sort of advise them on what products are best for their circumstances, that they work with a really good contractor or developer, and and also an accountant that can advise on what best lending structure or lending entity that needs to be in. So there's a whole load of things that have to be considered. And then again, it does come back to councils looking at planning permissions, perhaps how the government can maybe remove some of the red tape to make building a lot more accessible and a lot easier. And we've seen some of those things starting to happen on the sort of commercial, converting them into sort of C3 residential properties. But I think there's still a long way to go to make it a sort of smooth and profitable process.
I think just one point, I was going to say the positive side, if there is one, of some of the buy-to-let stuff, is the stuff that's exiting the buy-to-let market is generally being bought by a lot of it is being bought by first-time buyers. So it is kind of revolving back. And if you look at kind of the makeup of the market 15, 20 years ago, before buy-to-let grew, it was much more first-time buyers. So you're seeing a reversal of people who would have maybe been renting, 5, 10, 15 years ago. They're now sort of coming back and buying again. So you're kind of getting a slight reversal and trend back to, renters maybe buying again now.
Well, it's interesting you say that, Peter. I think you're onto something there. I follow quite a lot of journalists, and it's been very telling. Over the last 24 hours, I've seen about 10 journalists at the Times saying, we're looking for an example, a case study of a renter who bought their property from their landlord. So the Times obviously planning a story about exactly this. So if anyone is watching and they've done a mortgage with someone in that situation, do drop me a line, because the Times is looking to interview a buyer who's done that. Yeah. So there's a trend there. There's buy-to-let owners thinking about what they do, whether that's a sale, whether that's some of those development ideas that Ros was talking about. It's a sector under pressure, and it's clear that an increase in capital gains tax will not be welcome in the budget. We talked about first-time buyers there, and there is a possibility of a development on the freedom to buy scheme. Now, do you remember that? That was something that was brought up during the election campaign. It's essentially an updated, a kind of reheated version of the mortgage guarantee scheme that was launched by the Conservative government a few years ago. Essentially, the way it works is the state acts as a guarantor for first-time buyers who can't afford a big budget. Clearly, this is something that we should be talking about. But first question is has it disappeared off the radar? It wasn't in the King's speech, so it may not be in the budget. But what do you think about this scheme? Do you think it's worth doing, or is it just an old idea that should be binned?
Well, anything that can encourage and help first-time buyers has to be a good thing. I suppose it's all about lenders being able to sort of comfortably go to sort of 90-95% loan to value, and then the government will step in if there's any shortfall or loss occurred. But I suppose it's not just about first-time buyers being able to have a smaller deposit. You know, they still have to meet the affordability criteria as well. So that's really important. So it's one thing helping with the deposit, but then also they have to be able to do, meet the affordability criteria, which, you know, if you're in certain parts of the country can be quite challenging.
For me, I think, like, it's great when we get government-backed incentive, mainly because it creates a lot of press and people start to talk about it and start to think, oh, maybe there are options. But actually, I think there is a huge amount of options available for first-time buyers. It's come from lenders directly. So, like, you've got the Accord 99% loan to value, sort of 5,000 deposit mortgage available. You've got lenders like Generation Home doing really interesting things, like ejector seats and deposit boosters, and you've got Skipton with their track record mortgage. So the great thing about these schemes is that when they're in the press, they help to open up conversations, because we then get sort of first-time buyers wanting to speak more about, to see what their options are. But quite a lot of the time, lenders are sort of doing this themselves, really, to generate and to support the first-time buyer market. So the affordability is always the issue, which is why, obviously, recently as well, we've had the Halifax 5.5 times of income for first-time buyers. Nationwide, not to be outdone, going now 6 times for the first-time buyers. But there's a lot of higher loan to income multiples available for first-time buyers, which is great. Helps the affordability side of things. I think there's probably more innovation to be done as well when you're mixing it in with the green agenda. So properties A or B rated. There are some lenders where they can then use the lower electricity payments to help lend more. I think there's more to be done there. I also think the second steppers need a boost as well, because ultimately they're the ones that are going to be moving out of their first-time buyer property to make it available for the next generation. And so every step of the ladder has their challenges, but it's good when you get government-backed incentives. But there is lots of other, either private, like your own new scheme, or lender developed schemes as well, which has been really positive recently.
Well, Steffi, I mean, you mentioned a lot of lenders and a lot of measures there to help first-time buyers, whether that's increasing income multiples, whether that's the return of 95, even 99% LTV mortgages. So the sector is coming up with products to help first-time buyers, even without this government support. So I guess it begs the question, do we really need this government support? Is the sector itself doing its bit, and is it doing enough?
I think when we have government support, it definitely helps, because it gives confidence in the market. And so lenders who don't necessarily have the backing of a huge bank or their own sort of mortgage book, and to be able to be guaranteed to be able to lend to 95% it's definitely useful, because then you've got lenders that can lend to 95% who never would have been able to do that before.
Fair point. Well, that's something that I think we can all agree we want to see in the budget. Anything else that you guys would like to see that would either help lending or help house building? What's your wish list, Ros? What would you most like to see in the budget?
I think I'd just like to, well, it's, you know, I just want some certainty, really. I think it's just all been so up and down, and there's all been these, you know, it's like you said at the beginning, it's a new government. They've made lots of promises, and I'd like to see things in the budget that sort of promote growth and stability, and you know, give the confidence back to everybody.
Peter, what's top of your wish list?
So there's a lot of talk about housing and the 300,000 homes a year. I'm going through a sort of a big build at the moment. I'm just kind of very worried about how we're going to build 300,000 homes a year, even if we sort the planning out and all the other bits, because you try and get hold of a builder at the moment. We've obviously sent most of the Polish builders home for various reasons on Brexit. And we just have a massive skills gap. So, you know, it's very well making a statement about one thing. It's about having some sort of conjoined thinking around skills and education and, you know, getting all that in place. So I kind of would like to see something conjoined around trade and getting the infrastructure in place around the whole building piece. So, you know, something around more technical education would be really useful, because I think this isn't a building scheme for, you know, one term of a Labour government, assuming they get a second term. This is a 10-year, this is a 20-year building programme, because I think we're something around 4 million houses short. So this is a generational thing we've got to fix, and we need a generation of carpenters, electricians, plumbers, which we just don't have at the moment.
Yeah. No, that skill shortage in construction has been getting worse for years and years and years. Brexit, as you say, made it even worse. But let's be honest, it goes beyond that. Construction has got a bit of an image problem. You know, there is still this sort of cliched idea of, well, construction trades are somehow less valuable, less important than getting a degree. And, you know, working construction is just, you know, a high-vis jacket and a hard hat, and it's not really valued. And the fact is that there is lots of work, high-paying work available for skilled people out there, but not enough people to do it. So yes, as you say, it does need a government with a bit of vision to get more people into those trades, because otherwise we will be in serious trouble. We can't import the skills anymore.
Yeah.
So lots to think about there. Steph, is there anything that you would particularly like to see? We've talked about a little bit of support for first-time buyers, but anything else that you think could make a good impact on lending?
Yeah, so two things for me. One, very similar to Peter, I would like to see more money going towards apprenticeship schemes for bricklayers, anybody who's going to help with the house building process, all of your trades, essentially, because it's not just these 300,000 homes which we're wanting to build. We've got the whole private rental sector and the whole social rental sector that need to be at an EPC rating of C. So there's a huge amount of retrofitting work which will need to be done as well. So that's going to take a huge amount of personnel to get all of those to standard. So where are we going to get all these people from? At the moment, we don't know. So we have supply chain issues, we have material issues, as Ross mentioned earlier as well. And the second one for me is stamp duty reform. So at the moment, we do still have the reduced stamp duty up until the end of March next year. And that is currently, due to change. Labour manifesto said that they would be making no changes to stamp duty. I would like them to make changes to stamp duty, whether that be a permanent change to the bandings and the way it's calculated, or what I'd really like to see is something different with stamp duty, where it, especially for downsizers, because we have obviously an aging population. There are a lot of empty nesters sitting on sort of large property, but because of like stamp duty, capital gains tax, it just doesn't make sense for them to downsize. So I'd like to see some changes there and some more forward thinking with stamp duty.
Yeah, well, it's funny you say that. That thought has been echoed by Matt Poole on the chat. Matt says that do we think there'll be any changes to the current stamp duty rules, which are due to end at the end of March next year? You remember some of those reductions in stamp duty were time limited. So clearly we'd like to see a bit of clarity on what's going to happen there. The danger, of course, about them being left to expire is that you get these sort of bulges in the market. So you get people rushing to complete just before deadline on the 31st of March. So swings and roundabouts either way there, but stamp duty clearly is a key one there. I do know, reading the thread here, that several of you have been watching have been plagued by connection issues. Just to say that if you lost signal at any point, or someone rang the doorbell, or you went to make a cup of tea, you can watch the full show back on YouTube, listen back on Spotify as well at your leisure to hear all the discussions today. Let's move on to the drum roll section. Your regular watchers will know that each time we do a Star Broker of the Week award, and it is time to announce this week's winner. So drum roll, please. The Star of the Week, of course, is a broker who has gone above and beyond. And this week's winner is Kim McGinley from Vibe, who, together with Rosalia Natsara, has launched the first Women in Finance retreat. Now, this is an inspiring initiative which brings together women from across our industry to raise awareness, strengthen connections, and foster an environment of empowerment. So congratulations to Kim. She is our Star Broker of the Week. Now, have a think. If there is anyone you know who you think's gone over and above and really shone from a broker perspective, whether that's being entrepreneurial or just great service to a client, helping them get a product against the odds, do let us know. Get in touch with our sponsors, MPowered Mortgages, with your nominations. And I think there will be a link in the chat for you to do that. A little nomination form just takes a couple of minutes to fill in. But that, I think, is the end of proceedings for today. So whether this is your first time watching or your 26th time watching, you're very welcome. It's been lovely to have you with us today. And a big thank you, of course, to all our panel today. Peter Stimson from MPowered, Ros Kaywood from Streambank, and Steph Daly from the brokers Alexander Hall. Do join us in 2 weeks' time for the next issue of Mortgage News Live.